Well, this is closing bell. We are starting half an hour early because markets are looking real bad. 300 points lower on the Nifty, and we are at, now knocking at 24,000. And of course, the broader market is looking actually even worse. So some, 8:1 kind of declines to advances. 8 stocks outnumber for every 1 stock, which actually is higher. So it's a pretty red screen. Earnings, no earnings. I mean, markets broadly are down. You'd struggle to find stocks which are actually in the green. Guys, hi. Afternoon.
Hi.
Good afternoon.
Afternoon.
Just looking at those JSW Steel numbers. So optically, when you saw the profit number, it was looking like, it's a major decline. But that's because of some exceptional items. I think at an operational level, these numbers are now not starting to look not as bad because both the EBITDA and the margin seem to be tracking slightly higher than the poll. We'll get Nigel in to give us more color on this. That's coming up in a bit. But the stock is now trying to stage a bit of a recovery. But we can't say that for the rest of the market, can we?
I mean, we can't say it for the rest of the market. I mean, it's one can only hope that we are closer to some kind of climactic selling. I think the falls, of course, stumped many, even those who were expecting a fall. And I think we've got Rohit Srivastav now joining us. He's, of course, founder of India Charts, seen markets a long time, looks at technicals, macros, everything. Rohit, good to have you with us here. Thanks very much. I mean, you were expecting a bit of a pullback. That has happened. And then, but you were kind of expecting the market to stabilize, right? This is on the downside exceeded what you thought will happen. So where are we at in terms of indicators, and what's your sense?
We never static about our expectations. So we had a couple of different alternate scenarios. The only thing that didn't happen is that it didn't bounce back to 25,600 that we were thinking in between. Now that it's broken the previous low, and it's not done that for Bank Nifty yet, but the signs are that that will also happen. It means that we are witnessing a free fall, one which is probably not over, even though you may look at certain technical indicators. Look, for example, if you look at RSI, all of them are dropping below 30 for Nifty, mid cap, small cap, 500, all of these indices. Again, not Bank Nifty because that is still holding up better than the others. But today's break in Bank Nifty is indicative that it will follow through. So what I'm trying to say here is that in a free fall, these oversold readings are not going to really work. And you don't need to preempt an early bottom. You simply need to let it go. Something that I wrote in my long short report in September was that, you are in a seasonally bearish period till the end of October. India didn't peak out in September. It waited till the beginning of October. And US has still not sold off, but it looks like now we do have a peak in the US market as well. And all of this is going to continue to put downward pressure in the coming week or two. So don't look for an early bottom. Don't get into short-term oversold readings. We'll have to look for some of the medium-term indicators now to really get oversold, and that has not happened. I mean, I can highlight one of the indicators I was just looking at, and that's the, on strike, we have the number of stocks below the 100 DMA for the Nifty 500. So I'm taking a wider basket. The reason to take a wider basket is this is a broad-based fall, and you want to actually see when that number reaches extreme oversold, which is typically between 20 and 10% or below 10%. And we are right now at around 28. So we still have room for, that to really sell off and get into oversold territory. So it looks like the, fall may not be over. Don't make an early judgment. That is my, short take.
Okay, all right. Rohit, just coming back to you, just addressing JSW Steel's numbers for the time being. On the top line, there's a small miss actually in comparison to what we were working with. It's come in sub 40,000 crores. We were working with a number of north of 40,000 crores. But the reason that these numbers actually are looking better on the EBITDA front is because there is some gross margin expansion. There is an inventory credit of around 980 crores. That compares with an inventory drawdown of around 2,700 crores odd, which on a year-on-year basis, there is a gross margin expansion of around 150 basis points. Will require clarity on exactly why that's happened, but that's the reason that the operational number is better. On the profitability, actually, there is a one-off. There's an exceptional item of around 340 crores, and the effective tax that they're paid as well is much higher. So that's why the reported PAT number appears much lower than what we are working with. And in the same quarter last year, there was 590 crores of an exceptional gain. So the exceptional loss in comparison to an exceptional gain, that's a swing factor of close to around 1,000 crores out there. So in summary, the top line is a bit of a miss. We'll have to find out about this inventory gain that they have recorded. And that's why the EBITDA number looks much better. But the net profit number is lower than estimate because of the higher tax rate. And the other point is that, in fact, you do have the higher effective tax and one-time exceptional hit of around 340 crores odd. I'll go through the numbers and come back to you. Prashant, you want to take over?
No, absolutely. Nigel, thanks for that. That's a quick sort of first snapshot look at the JSW Steel results. Rohit, just to come back to you, I missed that NSE 500 number of stocks below the 100-day.
That's right.
Was that
correct?
And you're saying 28% are below the 100-day.
That's the number right now. It's 28%, and we could very well see it go to 20 to 10% before you say that it's extremely oversold.
We could go to what?
Anywhere from 20 to 10. Sometimes it goes sub 10% also before you get extremely oversold.
Right. No, I would imagine, just to clarify, the percentage of stocks below the 100-day, if that percentage increases, then you get to oversold conditions, right? That's what.
No. The number of stocks that are below the 20, and I'm not saying 20. I'm saying the 50-day average.
Okay.
That's with the Nifty 500. So that's 500 stocks. Out of these 500 stocks, 28% are now below this level. Okay, the 100-day moving average. That is what we are talking about. So now, if you get to a level where 10% of the stocks are below, I'm saying it. I'm sure I'm saying it wrong. It's that 10%. Only 10% are above. Okay, so we measure it as percentage above the level. Sorry for the mistake.
Okay.
It's slip of
So
tongue.
28% needs to go to 90% of the NSE 500 stocks need to be below their 100-day moving average. That's when historically you would classify this as oversold.
Yeah, so
we're still quite
10%
far
means
away.
that 90% are below, correct.
So we're still quite far away. We're at 28%.
Yeah, only 28% of stocks are above right now. So from 28 to 10, that's still a lot of room.
Okay.
And that should give us a lot more downside on the market itself, especially when the Bank Nifty gives in. See, what I was saying is Bank Nifty has just started falling today. And if that also does what the other indices have done, then it will add to the damage.
Okay, and what would be the critical markers on the Nifty Bank?
So breaking 51,000 today was the sign that, it's headed lower. It's also going to be closing, probably it looks like below the 20-week average. So that damages the weekly outlook. I will then be looking at something around 48,500 odd as the eventual level where it might stabilize in this fall. Similarly, if I put a level on Nifty also, it's going to be at least around 23,700. Now that may appear closer because it's already in a free fall. But Bank Nifty, I think, is just getting started, so it still has some room.
Just getting back to the mother market, US markets, you also said that the US markets perhaps may have peaked. Are you seeing a lot of downside, or would they spend time just consolidating around these levels? What's the call on the US markets?
Yeah, so I don't have the depth of how far down it will go, but what is clear is that historically we've seen the US market always fall ahead of the election. Okay, and so far it didn't happen this time. It usually happens by early October. It didn't happen this time because of the Fed rate cut. That created a lot of enthusiasm, a lot of money coming into the markets, buying banking stocks and small caps and so on. That sort of drove this rally. You saw that the Dow Jones actually outperformed the Nasdaq in the near term over the last couple of weeks. So a lot of money went into cyclicals and other places. But now that is petered out. We are seeing a loss of momentum, and I think that seasonal phase is starting to play out where markets actually dip into the US elections. Now there's also a case where they actually improve after the election results. So I don't know if it will follow both things exactly. But we do have short-term momentum indicators giving us a sell signal. So therefore, I think the pre-election sell-off has at least started. So in that sense, we are saying, probably look for the bottom only closer to the US election around 5th of November. That would be a better time to take a judgment on, whether we are bottoming or not. So I think the next week should still be seeing much more selling pressure built up in US equities as well. And unfortunately, along with that, you're also seeing US bond yields rise. So that is acting as an additional pressure point to the US market, apart from just the seasonal factor.
Rohit, hi, good afternoon. So, been listening to you. Let's just come back to the Nifty for a second and talk about sort of big picture levels now, since you're not ruling out the correction continuing for a while. What are the next levels that you're tracking? We got a view, by the way, from Lawrence Belanco a couple of days back. I mean, he said that a retest of the 200 DMA could perhaps also happen, which is about some 750 points away, 700 points away from where we are. Your thoughts? Nifty levels now.
Yeah, so 23,700 is going to be the first one that we're looking at on the downside, and 23,200 is a second level that we can actually put out there. The first one is more based on Fibonacci extension ratios in terms of the wave structure where it can head. The second one is based on a classic pattern known as a head and shoulders stopping pattern. So we actually check out the head and shoulders pattern on the Nifty, and we extend the target down, then it goes to around 23,200. So these are two levels that we'll initially start with. I can't rule out that what happens in a free fall. Sometimes all levels get exceeded. So right now we can't say that okay, this is the level at which it's going to bottom. But these are the sort of goalposts that we are looking at for the market on the downside.
But Rohit, that's a fair caveat to put in over there. The question is that you still seem pretty convinced that this is not over. So then, so short trades are possible at this point, because all the levels are at least 300, 400, if not more, points away from where we are.
Yeah, I think the risk reward on bank Nifty is still very good on the short side. On Nifty, if I look at the hourly chart, the RSI is down to a 17, which is sort of oversold. So I would like some kind of an intraday bounce to really do something on the Nifty if I have to add to shorts over there. Otherwise, I wouldn't add them right away at this point, given the reading of an hourly oversold. So that's a very short-term thing. So something, if not today, maybe on Monday, you get some kind of an intraday pullback, 100, 200 points, you would like to actually sell into it. That is how I would think about shorting the Nifty, but not immediately, not at this level.
Okay, so got that point. You're saying that Bank Nifty is a better short than the Nifty at this point in time. What about any counter trades, to play even bounces on the upside? And I understand this will be for very, very nimble-footed traders. But since the Nifty is so almost oversold now, would you play any counter trend rally on the upside, either through one stock, two stocks, index, anything on the upside?
So there's this old saying, right? Don't catch a falling knife. We are in that scenario.
Okay.
You don't want to catch a falling knife. It's going to cut right through your hand and go through.
Gosh. So this is a falling knife, huh? That's what you're saying.
Yes, absolutely. This is a falling knife. In fact, most people have not seen this kind of a decline, I think, since COVID. You haven't seen it go one way, because every time you had short-term oversold conditions, the market bounced back, either mid-caps or large caps. Something supported the market here and there. And we've never really felt this kind of pain, which is almost one-sided, which is why I think people will not be able to relate with it at this moment, because it's too far behind in time and there's no recency bias. So, which is why you need to be extremely cautious, let it happen. Don't try to catch a falling knife. When it goes this way, they're selling every day, which you can't relate with anything, whether US market bounces, doesn't bounce, and it keeps falling. So this is not something you want to really interact with.
Rohit, so why is this a fallen knife? Should we delve on that a little bit? What's your sense? What are the dominating drivers?
So here's a combination of things. For at least 8 to 9 months, I'm sure you've heard yourself, several fund managers raise risks on the side of valuations. On the other hand, we've all been tracking only one thing, which is there's a lot of liquidity in our market. Right, so there's a lot of liquidity coming in that's keeping it up. So we continue to trade momentum. Now we know, as technicians, we know how to trade momentum. We can come up with a setup. We can follow it up with a moving average, or use classic Dow theory and hold on. But the question is, momentum is lost. Then what happens? Because you are trading a market that is overextended on valuations. Now simultaneously, we have had the hurdle of earnings growth, right, coming down significantly over the last 2 quarters. Now there is hope. Yes, that the government spending kicks in again in the second half, and that works out. Or if interest rates get cut, that sort of works out. And I've also highlighted those hopes over the last month or two, so I'm not denying that. But the problem here is that we are starting to see the first breakdown of at least the rally that started from March 2023. Okay, so let's at least take that segment in mind. Now, when we take that segment, then none of the indices that we're talking of, whether it's Nifty, mid cap, small cap, or the 500, during this time period, they did not break the 20-week average. That is the interesting part. The Nifty did so once in a year back in October of 23, but the others did not. And they've just continued to hold on to this level. Now today, and this is a Friday and it's a weekly closing, so it's a good time to highlight it. Not just the small cap and mid cap, the Nifty 500, Bank Nifty and Nifty, all of them are closing below the 20-week average. This is the first time since March of 23. So this is like after 18 months that you are actually doing that. So it at least ends the rally that started from March of 2023. So that is one segment that is coming to a halt. Now, what that usually means is that you go into a multi-month consolidation phase, or alternately, are we going to go into a slightly more bearish phase? Now, that's a choice you have to make. We might not be able to judge that right away, but it means that there is downside, in the medium term as well. So one thing is looking for short-term bottoms, when we get down to that 23,200 or whatever we talked of. And when we get there, definitely there's a bounce, you'll get a retracement. But will you actually go back to the highs? That becomes a bigger question, and it may not happen immediately. You may get multiple rallies that have sharp retracements, and then you get another round of selling, and then that can go on for months together, just like we saw between, say, October 21 and June of 22. Something similar can also play out. So those are things to keep in mind, that when you're in that kind of phase, then performance gets extremely narrow. Like even that time, you had a couple of large caps, and then you had the autos that actually outperformed, but not everything else. A lot of things actually went down. This time around, it's been a much more broad rally. You've had overbought readings in so many things, so you're seeing a lot more selling across the board. I think the bigger danger here, if you ask me, is actually in the mid cap, small cap segment, which has been through a 3-4 year type of bull run. Usually when the mid cap bull run pauses, so even if the Nifty does stabilize at some point of time, the mid and small cap bull runs can actually go into a corrective phase or an underperformance phase for a almost 2-year period. This has happened at least the last 3 times we've seen a 2-year-long underperformance phases. 2005, 2006, 2010-11, 2018 to 2020, and so we are at another juncture where something like that is also possible.
Okay, all right. I think the clear takeaway is that one needs to be on guard, and this may not be entirely over as yet. Rohit, that's helpful. We'll keep those levels in mind for the Nifty, like you said. First port of call is going to be 23,700, and if that goes, then we could be looking at some more sort of deeper lower levels. Got that. Thanks very much. You have a good weekend, and we'll connect again soon with the market call. The market, by the way, 314 points down. On the counter trend move, I mean, not that there is too much to speak of, but ITC is the one that's managing to retain a little bit of that gain. There's Trent that's trying to pull back from the lows, but it's not really being quite successful. So not too much to report on the gainers list. IndusInd Bank, of course, is still very much down, about 19% Lever and ITC. These are your only other 2 stocks, where the gains at least are about 1% to about 2%. Now, let's complete the view on technicals, because earlier this week we caught up with Lawrence Belanco of CLSA, and he had given out the red flag as well for the Nifty specifically. He did say that the market seems to be sort of in a downward leg that is not over, and a test of the 200-day moving average is not ruled out, and that level comes closer to 23,350 on the Nifty. Take a look.
Just look at what we see on the daily chart, and basically the break below the 50-day that we saw at the start of October. We've seen downside momentum now accelerate, and the classic reversal pattern being the head and shoulders that we've seen develop August high, the October high, and then obviously this early October high, forming that formation. And we're really looking for a move back to the 200-day moving average, which sits around the 23,300 area. So we see at least another sort of 5% downside. That'll take the market back to long-term trend support. Yeah, the sector that we've really been highlighting as where the greatest downside risk is in the PSU space. So if you look at the BSE PSU index, that started to roll over basically from June, July, and since then we've broken down. Yesterday we saw that index break below its 200-day, and that's sort of leading the downside. And if you want to get sort of more granular in this, you can look at the PSU banks versus the private banks. Now, the PSU banks have been great outperformers from the COVID lows up until the start of this year, and since then it started to roll over. So essentially now we've seen private banks hold ground while the PSU banks underperform. So, if we get down into subsectors, but more broadly, PSU is the most vulnerable space here, having broken below its 200-day yesterday. Because we think the Nifty does have downside to its 200-day, we think HDFC will remain in this range, but it'll be a relative outperformer. So it is a place that we think you can accumulate here. And once this correction's over, we think we do see the setup for a potential major breakout there. So use the current volatility as an opportunity to build positions in HDFC. The breakout area is just above the 1730 area. So clearing above that, holding above that breakout really gets us upside targets of 2,500 plus. So that's where we would see this breakout taking HDFC Bank once we clear through that 1730 area on a sustained basis.
Welcome back. You're with us on Closing Bell, and we have Vikas Khemani, founder at Carnelian Asset Management, now joining in to get some perspective on what's turning out to be the first real fall this market has seen in many, many months, dare I say years, ever since we came out of COVID. Vikas, thanks very much for joining in. So, some perspective and big picture sort of thought is much needed at this point in time, because the fall from the peak is about 8% now. And we were just speaking to some chartists before, you joined in. And they are saying this could go on, maybe another, 5% on the downside. Your thoughts on where we are, how we are poised, and what the best approach would be right now? First of all, do you think that we are close to the bottom, or would you not be surprised if it continues for a bit?
So we've been in a one-way kind of a bull market for last 3-4 years. We made significant returns this year, across the board. So whenever this kind of rise happens, a bit of a correction, consolidation, is always good. And it's not 8% from the top is not like a lot of correction. If you see last 10, 15 years or any period of history, there are times in an otherwise bull market, you see 20-25% correction as well. So it really depends on the nature and the type of the market. Last 2 years, most of the corrections were short-lived and very shallow. I think this is the first time probably you are seeing slightly wider correction or deeper correction, especially in mid and small cap space. And that is, I think, probably creating a little bit of earn-out situation in the market. Also, it has got coincided with bit of a redirection of the flows towards China, and also a little bit of sort of softening in the earnings season. So I think it's good that this kind of correction sort of is taking place. It is always healthy, in my opinion, from a medium-term to long-term perspective. I have no doubt that the long-term fundamental structures of India is in place, intact. We are in the middle of a structural bull market, but intermittent corrections are necessary, and this is one of them. Many more will come in the future. Regarding your question, whether are we close to the bottom, I'm not sure. That depends on really how far market settles down. But I don't see a situation where markets can correct, let's say, from the top 20% kind of number, but probably 3, 4, 5% from here more could get market stabilized. And I would always say that any panic kind of markets are the best markets to kind of deploy capital to sort of make fresh exposures, and especially in the mid and small cap space, a lot of deeper corrections have happened. 30, 40, 50% corrections in many stocks have happened. So look for your own picks, look for ideas, and no need to be rushed. I don't think markets are running away up in a hurry. So we will see a good consolidation phase of the market. I would call a 22,000 to 25,000 kind of nifty broader range market should remain between for next 3 to 6 months.
22,000 to 25,000 is the range for the next 3 to 6 months on the Nifty. So where are you deploying the money right now, Vikas?
So right now, I think, fortunately we've not created a lot of cash, but for last 1 month, whatever money we received, we didn't deploy. We are kind of sitting pretty much on cash on whatever the fresh inflows came, because we were kind of a little bit concerned about the direction of the market. But having said that, we are looking for an opportunity, stock specific. We are eyeing on ideas, and we will buy as and when we think it's right time to deploy capital, right time to kind of bite into the. And at the end, we don't deploy at the market level. We deploy in the companies, and so for us, the company and the target price of those companies is far more relevant than really the market levels.
No, absolutely. I think one of your ideas is doing well today. Loris was up 6-7%. Because hi afternoon. You said 22 to 25. Will the lower end come into play at some point? I think
nobody can call that out, to be honest. These are they really depends. Many things could be flows, could be market sentiment. So 3, 4, 5% correction can, so whether we will go to 22 or not, I don't know, honestly. But broadly, right now, the mood has shifted on kind of sell on rallies to buy on dips kind of market. So I think it kind of consolidate the easy money, which everybody got used to. I think is being questioned, and that's a good situation to be in my opinion, because markets are not, the way people have made money last 1.5 years, 2 years. It became very easy, and I think good that reality check happens, the expectation gets toned down, and that's always healthy for a long-term structure of the market.
Yeah, a lot of FII selling has happened because in your earlier life, you've also been on the institutional side, the sell side, etc. as well, right? You've interacted with all the big foreign investors here in India. I'm sure you speak with those people as well. So give us a sense of what is happening. I mean, the selling that we've seen, what's driving it, and what's the mood like there in that constituency?
I think, Prashant, I don't think mid and small cap selling is driven by the FIs because there's not a lot of expectation or exposure out there. But I would like to give you a little bit of picture that I think if you last 3-4 years, we saw a lot of money going away. So whenever Fed raises interest rates, FI pull money out of the country, right? Out of the emerging markets. And that's what happened. India lost money when Fed was raising interest rates. And I think in my previous interactions, I had said once it starts coming down, the Fed rates peaks out and starts coming down, you will see FIs flow coming in. So which began when the Fed cut rate, we saw FI flows coming back into Indian markets, in emerging markets, including India. But recently, because of, FIs were significantly underweight in China, because of recent change in policy in China, a short-term and the market setup change in China, short-term reallocation has gone back to China. In my opinion, broadly, more or less, that has settled down. Now, any incremental money flow which is coming towards emerging market, will only kind of be positive from India. So it could remain 1-2 months here and there, cannot be rolled out. But I do believe that India will continue to receive large part of the flow, large part of emerging market flows, and emerging market in general will receive more flows because Fed rate is expected to come down further, and the trajectory is looking only downwards. So as that plays out over next 6 months, 12 months, 18 months, you will see more and more flow coming from FI. So no FI is leaving India. It is actually reallocation of the flows first, between China and India. And as the overall basket goes up towards emerging market, you will see more flow coming towards India. So I don't think there's any reason to panic or worry. No FI, according to me, is taking any negative view on India. So that narrative sort of probably may not be correct. And that is how I will see. And as India delivers and remains over next 3, 4, 5 years, I see a situation where FIs will continue. I mean, today, most FIs are underweight India. In general, I'm talking overall FI flows. If FIs to become, all global assets were to become Indian, equal weight in Indian markets, India can get anywhere with $1 trillion kind of flows over next 8 to 10 years. So we should keep that broader picture in mind rather than getting worried with the short-term monthly outflows.
Okay, absolutely. So don't keep the short-term myopic view. Don't let that cloud your long-term and medium-term judgment. Take that point completely, Vikas. Tell us a little bit about yourself and how you've been looking at the market. And I mean, you have been doing exceedingly well, right, with the whole theme around capex, the PLI segments, the key beneficiaries, manufacturing. But as the market has been now cooling off, have you been taking some profits as well? Are you redeploying? I mean, what's the change in the portfolio? Any broad, big change, if any?
I said that we've not deployed capital in the last 1.5 months because we were kind of expecting some corrections. But within that, we have taken some money off table in some of the overvalued names where we thought things have played out. So, but it's not that we're sitting on a lot of cash. I think we're about 5-6% odd cash we're sitting on system, and which I think we will not be in a hurry to deploy. Otherwise, I don't think, in my opinion, any broad changes in the India story happens. We will see financials doing very well. We'll see manufacturing doing very well over next 12 months or even longer. We continue to believe that, entire IT pack, within IT, there's interesting place where one can continue to do well. So broadly, our thesis has not changed on India story. A little bit of here and there can happen. We have not made, I can tell you, a lot of changes in our portfolio. We are quite comfortable with what we have in our portfolio right now.
What about banks and the earnings that we've seen? You are bullish on banks over the longer term, but just purely talking about what we've seen in Q2 and the broad-based nature of the rise in stress, particularly in unsecured lending. Do you think it's going to last for, 1 or 2 quarters? Or typically when such cycles take place, they tend to last a little longer, maybe for a year, maybe even longer. Are we at the beginning of such a longer-term cycle? assess the
I think-
tenor of this stress?
I would not believe a very long, but I would say 1 or 2 quarter of, see, typically a lot of unsecured loan growth happened, in last 1 to 2 years, and that is where RBI has also raised a bit of alarm. And I must give credit to RBI for being such a counter-cyclical measure and kind of raising that alarm before it becomes too big. So I think that was a great job, and that has, I think, alerted the system. So the growth has started slowing down, and a little bit of pressures. A good part is that the unsecured note loans is not a very large part of the overall portfolio of many banks, especially the ones where we have invested. I mean, ICICI Bank is reasonably well placed. So most of the companies that we have exposure to, they are very well placed. They don't have very large exposure. Of course, some of the microfinance piece is kind of under stress, which is where we saw yesterday IndusInd Bank's number coming through. We don't own it, but the fortunate part is that so you need to be worried about, I think, microfinance as well as the unsecured loan. Maybe a quarter or two, most of the pain should be behind, partly through provisioning, partly through slowdown in the growth. And most banks, once they are agile and alerted, they will take corrective actions. So I guess probably a quarter or two should be the pain in the system.
All right, Vikas, we'll leave it there. Good conversation and a good perspective, and we'll continue to get you on the program as we assess this sell-off. On the Nifty, mid-cap and small-cap spaces, we are now approaching, we're almost there, the 10% correction levels from their respective highs, 9.8 for the mid-cap and about 9.7 for the small-cap in indices. The Nifty has lost about 8.3, Bank Nifty has lost about 7.5%. So that's the state of affairs from the respective all-time highs. We'll take another quick commercial break here. We continue, of course, our coverage on markets. Prakash Diwan also with us on the other side. Stay tuned. Okay, welcome back. It's 300 points lower on the Nifty, and it's looking pretty bad out there, with broader markets also under immense pressure. Dixon is the one that we're going to focus on. The stock should come up on your screen, and what a head fake it's been, right? Started at the high point of the day, but that was pretty much it. It printed at the high right at open, and then from there it's been just one way south. 10.5% lower, and of course would be what, 14-15% off the day's highest level. But what's going on here? Because numbers were strong. Upasana is here with some context. Upasana.
Well, the stock is seeing a bit of a profit taking in tandem with the market construct despite the strong numbers. In terms of stock move, the stock is 14% off its 52-week high and 11% down this week. Now, coming to valuations in the EMS space, when we look at the one-year forward PE of EMS companies, valuation of Keynes and Dixon appear to be quite expensive as compared to other listed players. Now, coming to Dixon, the consensus rating has, analysts have given a buy rating 15 out of 32, hold rating 7 out of 32, and sell rating 10 out of 32. Now, Nomura has given a buy rating with a target price which is highest, that is around 18,654 per share. Kotak has given a sell rating with a target price of 8,430 per share, which is the lowest. Now, when we look at the company's Q2 FY25 numbers seem to be quite strong. Revenue was above poll estimates, while PAT and margins were largely in line. Company has also given a guidance for FY25 in which company says that revenue should cross 40,000 crore mark versus 32,000 crore guided earlier. And in terms of margins also, company has indicated that it will range between 3.7 to 3.8% on the back of changes in the sales mix. So all in all, we are seeing strong set of numbers, but valuation is where the key lies.
Okay, all right. Thanks very much for that, Upasana. Yes, it's been a really disappointing show in terms of the stock price performance for Dixon. But then, as sort of we've been discussing through the course of the day, that perhaps a lot of the optimism was already built in. Prakash Diwan is our next guest on the show. Prakash, it's the color is red this Diwali, it seems, right? And we're getting very stark reactions on earnings. Let's actually start right there, Dixon. I mean, Amber, the market celebrated it when it came out with good numbers. Dixon's getting a very, very different reception. Your thoughts on this space?
Good afternoon, Surbi. So you're absolutely right. I think given the condition of the market, the last few days we've seen immense amount of profit booking come into picture, and when people look at profit booking, it's usually the ones where you sit on good profits. That's where you take off money from the table. And that's exactly what's happened in the case of Dixon. The valuations, as Upasana explained, were a stretch. The performance is absolutely and undoubtedly very superlative. There is nothing taking away from the fact that this will perform and continue to outperform. But are you willing to pay this kind of a multiple at this point in time is the big question. And when you take money off, you take it from where you have profits and not in distress. So that's what has happened. It's a well-discovered, well-covered business. Nothing very surprising or new in the sense that it's doing well. But I think it's just the mood of the market. At some point, mind you, once people start looking at valuations to be again comforting, and you are seeing some sort of a momentum come back, and I don't know when that happens, you will see people come back into the counter as well. So it's just mood of the market that demonstrates. It's a classic story where good results also don't get rewarded, at times when the market condition is such.
Okay, by the way, the market, for what it's worth, I mean, the bulls are trying to at least not go down completely without a fight. We were looking at a fall of little over 300 points when we started the show. Now it's about 290 points. So optically, one could argue that it's just 1.2% lower, but I think those who are in the market will realize that now this has been happening consistently for several days. And from the peak, that decline being 8% seems fairly a lot for now. ITC, Axis Bank, Lever, Britannia, and maybe a Sun Pharma. These are your few green spots on the screen today. That's how it's playing up. Prakash, IndusInd Bank. I think it's all well documented by now. MFI, stress, credit card issue, unsecured issues. But this kind of a reaction, again, is warranted, justified. Is there a case at all in terms of valuations? Because look at the stock. It's anyway been hammered through the year, right? It's down almost 27, 28% in any case, even prior to, today.
No, absolutely. I think through the year it was getting punished for its weakness in the core banking side. And remember, IndusInd is more like a NBFC under the banner of a bank. The way its business segments are stratified and structured. The whole year has been such where a lot of caution has been expressed in unsecured loans and segments which have been challenging enough. And that's where it kind of struggled. And now you have the MFI debacle. I've been talking about this MFI segment being a bit of a risk pocket for some time, and anybody who is in the space is bound to get re-rated downwards. So that's what's happened. The numbers will continue to struggle. The improvement will take some time. So I would believe that's the case. But on the overall market, I just want to tell you one simple thing, that it's just been a couple of days, but the worrisome part is not just that percentage fall from the top or wherever we were. It's more of the FI exodus was being matched by the DI inflows, and they were sitting on a huge amount of cash, 1.6 trillion or whatever, but that already has started getting exhausted. So people are more worried about what happens when that firepower, that dry gunpowder, doesn't remain as it is. So that's where it is. And some of these banks which are getting hit badly, are the numbers as bad to have an 18-19% of a cut? The answer is probably no, but there's no respite. There's no buying coming into some of these names, and that's exactly where. So the moment the DIs take their finger off the button, the buying button, you will see this kind of a fall in quite a few of these names which have bad results as a trigger.
The question is, will they be forced to take the button, take the finger off the button because they've already kind of put money to work, right? That's a big thing. Actually, that is the one thing which may accentuate, as Prakash you put it. And we were putting that question across to Ramdev and others yesterday, but we'll have to see. Of course, there's lots of variables, and the most important variable out of all of this is whether this intensity of foreign selling will continue, because that's got to be matched. Hopefully, a lot of the equity supply which has been coming in, as it always happens, maybe for the first time in this cycle, we will start to see some deferments and those kind of things. The pipeline may not be as strong as it was looking even a week or 2 weeks back, but all that we'll let us see. By the way, I think I don't know if you have any views on the company which is coming up with the issue Afcons. It's had trouble in the past as well coming to the market. And Shapurji company, infrastructure play, I guess bad timing in that sense. There's of course Vari as well, which collected some $30 billion. So no shortage of demand there, but then now it's got to come to the listing will happen. Any thoughts, Prakash?
Yeah, so Prashant, rightly so, the IPO market has seen a drying up of supply of liquidity by the Vari. I mean, you saw the participation, particularly on the retail side, has been phenomenal. I mean, it's an IPO that was much awaited, and people had kept aside capital. I know people who've been, only talking about participating in this IPO and none other through the year. So, that's why Afcons might probably not be so overwhelming. The response might not be so overwhelming. The business is good. From a valuation perspective, what they are offering it at is also not over the top. That does leave some room, this thing on the table, profits on the table. But you'll have to be a long-term, you'll have to have a long-term outlook. There's nothing like an IPO post-listing pop that Afcons probably promises. But if you want infrastructure plays which have got a much better proven track record, there are many. I really don't know why anybody would want a new this thing. And I'm not a big IPO fan, as you know. I always wait for businesses to show some sort of a this thing. Only then you'll find value. So in Afcons, probably value is also missing. So let's see. We'll wait after it gets listed and see what happens in terms of the market response and, of course, the performance of the company going forward.
Okay, all right, Prakash, stay on. We'll come back to you in just a bit, but let's get back to stocks and numbers and some earnings. From the pharma space, Glenmark Life and Laurus Labs have been reacting. Vinny is joining in with the updates. Vinny?
Yes, so we have both these stocks reacting in trade, but opposite reactions coming in. Now, Glenmark Life Sciences, when you look at it, it has seen a sharper fall in trade today. Why? The plant shutdown that was taken by the company, that is impacting the first and second quarter numbers. So the first half of the year was impacted by this plant shutdown. Revenues were down by 15% this quarter on a year-on-year basis. Margins have declined more than 150 basis points, and they have also lowered their FY25 guidance. Previously, the guidance for revenue was around 12 to 13% growth in FY25. Now they've lowered it to just a high single-digit top-line growth is what they're expecting at the end of the year. Talking about some of the internals, whether you look at a generic API business of the company, that's decreased by 11% on a quarter-on-quarter basis and 12% on a year-on-year basis. Even the CDMO business, that's seen a decline on a year-on-year basis, a muted decline, not much of a sharper decline like in the API business, but a 5% decline in the CDMO business. Overall, even the GPL business of the company has not done well. So this is a main pressure point coming in for the company overall, especially the API business, which has seen a bit of a sharper fall. Now let's move on to Laurus Labs. That's a good set of numbers. Actually good. Why? Because CDMO business, that started seeing a pickup for the company. They're highlighting that the Biosecure Act in the US, that is something that will be leading to a better pipeline for the company in terms of projects. They're getting more inquiries, and CDMO business accounts for around 24% of their revenues, and that is seeing a recovery. So that is a bit of a positive. Though this time API was a bit subdued in terms of the growth that we saw, but overall CDMO business seeing a recovery is something that's exciting the street, and analysts are also highlighting as a positive sign. Management has reiterated their 20% EBITDA margin target for FY25. Despite the first 2 quarters being a bit subdued, they're still positive that they will achieve that 20% target. So yes, that's why a thumbs up coming in for Laurus Labs, and we're seeing a bit of an up move there.
Okay, all right, got that, Vinny. Thank you very much for that. Prakash, before we let you go, any thoughts on Laurus or any of the other pharma names? Actually, the season that have reported numbers, would you be interested in anyone?
So I think globally, if you see, pharma is one space which probably will continue to still attract capital, but this kind of capital is not momentum driven. It's very long term in that sense. On Laurus, we've not seen anything much happen over the last many years now. The guidance has been always a bit too aggressive, and then kind of there's disappointment on some quarter or the other. And the other part is that because it has a few verticals that are expected or anticipated to fire on, and then there's always something that goes wrong with one or two of them. We've not seen that stock history being very, very promising. But I believe you'll have to wait for that to stabilize in terms of some of the other businesses as well, not just CDMO and API. So once that happens, yes, it starts good. But I've never been very keen on buying into it in any case. I've never recommended this also. On other pharma names, I think I'll just leave you with one thought. If you look at Glenmark Pharma, not Glenmark Life, we spoke about Glenmark Life right now, but I'm saying Glenmark Pharma, look at those numbers, look at the scale that they have attained. My sense is this is one business that's getting to be very resilient, and it's now in the same category as a Lupin was at about $1,000 or a Sun Pharma at 1,200. So that's where it kind of has resilience. The risk reward becomes very favorable. The numbers tell you that the growth that they've clocked and the geographies that they have started seeing contribution come from is very promising for it to continue to chug along. So I would look at that as an allocated area within pharma, but I'm quite positive on pharma overall. Glenmark Pharma, of course, stands out from the numbers that we.
Prakash, HDFC Bank is the only bank which is going to go home with gains this week with a 3.5% rally. Most of the other private sector banks have seen a big fall, whether it's IndusInd Bank or RBL Bank or even a Kotak Mahindra Bank. I think that's down nearly about 5% this week, 5.5% now this week. Did you go out and buy HDFC Bank, perhaps as a hedge against, it's a bank which stands out in terms of its asset quality? It's done well in volatile, uncertain times.
Yeah, so Rima, the fact is that whatever selling had to happen in HDFC Bank happened before the rest of the banks got on the list. So it probably there's nothing much to be sold off in that sense from people who wanted to get out or would want to get out. Yes, you're right. At 1740.50, it offers a very, very strong risk reward. And, I'll tell you what I liked about the numbers, and we spoke about this. Being a Saturday, we really couldn't talk much about it in the markets. But when the numbers came out, the deposit growth is what they've been trying very hard to, focus on. And they've managed to do that. And if this is the start, you'll probably have the next couple of quarters becoming very strong on that. And credit growth is something which they can anyways expand pretty well whenever they want to. It's just a matter of choice right now. So yes, you're right. The metrics are falling in place. All the parameters which are out of whack have started seeing some semblance of coming into tolerable ranges. I would be quite positive on HDFC Bank. It's just a question of whether you want to buy it now, whether you want to wait for it, to kind of stabilize at lower levels. But I think it's a good time to look at it for sure. You're right.
All right, Prakash, we'll leave it there. Thank you very much. Hope next time we speak, we have a little bit of stability. Today is, of course, not the day. Thank you very much, and have a restful weekend. We'll chat again. We'll take a break. We're going to be back with Shibani Sarkar Kurian of Kotak Mahindra AMC on the other side. Stay with us. Welcome back. Shibani Sarkar Kurian from Kotak Mahindra AMC is now with us. Shibani, thanks for waiting. Appreciate your time here on CNBC. Markets, of course, are down, but I just want to pick up on something that we've been sort of talking about over the last 1 week, which is, and of course, we've heard it from FMCG and consumer companies about this a bit of a slowdown that we are seeing, right? So urban is bad. Rural, is it really recovering big time? One doesn't know. So it's a quandary. Just your thoughts, Shibani, on that space and what you're seeing.
Yeah, hi Prashant and good afternoon. So the consumer space, of course, we've heard a lot about from some of the numbers that have come through in terms of the management commentary. So there are two aspects to it. On the rural side, there are data points which seem to suggest that rural is showing some signs of improvement. However, the improvement is fairly gradual and slow and steady. It's not a big bang improvement that's taking place. Premium consumption, which has been the predominant driver so far is possibly plateauing out to some extent. And on the urban mass consumption side, many of the companies that have reported numbers have suggested that there is some degree of slowdown that's taking place. So there is a mixed bag where the consumer sector is concerned. Of course, a lot is riding in terms of the festive season and possibly the wedding season that ensues post that. And so far, again, in the festive season, what we have seen is, again, a pretty much a mixed bag. So there is no conclusive trend that's coming through where there is an improvement that is visible. On the other hand, as you rightly pointed out, the urban consumption slowdown at the mass segment is something that we will have to wait and watch. Now, within the sector, of course, stocks are trading at valuations which are not cheap, and valuations are somewhat stretched in pockets. And the way we have been positioned on the consumer space, we have preferred some of the discretionary names in our portfolio. But overall, our weight on consumers has been neutral to slightly underweight, and that portfolio stance continues. We will, of course, wait and watch and see how the next few days pan out from a festive season perspective. But as I said, at this point in time, it is pretty much a mixed bag, and there is no major conclusive trend of a sharp improvement that's visible on consumption.
Shibani, hi. Did you own any of these banks where we are seeing incremental stress on the asset quality? Say an IndusInd Bank is one of the big accidents of the day. Earlier, you had even RBL Bank, but even banks like Kotak Mahindra Bank, for instance, have seen, a correction. They've spoken about how credit costs are going to, at least related to the credit cards, will remain elevated for the next 2 quarters. Do you own any of these in your portfolio, and what is the approach now?
Yeah, so we have financials in our portfolio. Of course, our overall financials weight in the portfolio has been underweight for a while. And our bent of the portfolio construct has been mainly towards the large private sector banks. And that continues to be the case. Now, when you look at the banking sector, a quarter back, we were more worried about the LDR ratio, deposit growth picking up, and the difference between loan growth and deposit growth. Now, the entire focus at this point in time seems to have shifted where asset quality is concerned. And of course, the numbers that have come through have shown build up in terms of stress where unsecured lending on the credit card, personal loans, as well as MFI goes. If you look at the banking sector over the last few years, the sector has seen Goldilocks period where asset quality stress was virtually non-existent. And therefore, some amount of that stress coming back on credit costs inching up is part of the normalization process. And of course, in some pockets such as MFI, there has been concerns where over-leveraging goes, and therefore you've seen a rapid build-up in stress in those pockets. But by and large, if you look at the larger private banks, one, they have a fairly diversified portfolio. Secured lending is still a fairly large chunk, which includes mortgages. And also remember, over the last few years, these banks have built up provisioning coverage, which means that they are fairly well placed, and some of them even carry some amount of contingency buffers at this point in time as well. Now, near term, there are clear headwinds. Loan growth per se has also slowed down at a system level. The banks are also focused on deposit growth, which means that some amount of margin pressure will still continue. And of course, we'll have to wait and see how the rate cut cycle plays out. But banking, especially the large private banks, from a risk reward perspective, if you look at valuations do appear to be fairly favorable. And while we do see near-term stress, from a slightly longer-term perspective, that segment seems to be fairly well placed on valuation.
No, absolutely. By the way, Shivani, this question about cash levels at a company at AMC, at mutual funds, could you give us a sense of where are we at as we finish this month off, the fag end of this month? Because some at the margin concerned that if the selling continues from foreigners, we've all been sort of saying mutual funds have bought dollar for dollar what foreigners have sold. But if this continues, will we get into some trouble here, at least near term? Possible? Or you think there's enough cash and inflow which will take care of things? There is also the equity supply, right, into that mix.
Yeah, so you're right, Prashant. Some of that equity supply in the mix has possibly been one of the reasons why, if you look at from an overall deployment perspective, some amount gets diverted there. However, a few things to note. One, from the SIP perspective, flows continue to remain fairly sticky. I think there is a definite change in investor behavior over the last few years, which has meant that if you're looking at investments are coming in with a longer term perspective, and therefore the SIP flows continue to support in the overall scheme of things, and that I think should continue. Secondly, there has been some degree of maturity where investors go when, in the previous markets where, there was market correction or volatility, investors would see some degree of panic, especially the retail investors. I think with a lot of investor education, some amount of that has also possibly changed. And that's possibly a structural change that you're seeing in terms of the mindset where retail investors are concerned. Now, it is possible that some amount of cash would have been deployed, but as I said, as long as the SIP flows remain fairly sticky. Also, remember there are funds which are the hybrid funds or the balanced advantage funds, which will possibly deploy money as markets come off and increase equity allocation because of the nature of the funds. So that all of those together would mean that over a period of time, flows from a domestic perspective should remain fairly stable. However, near term, of course, it's difficult and we'll have to wait and see how that pans out. So far, as you rightly pointed out, whatever FII outflows have been matched dollar for dollar with domestic institutional investors buying, and that has lent some degree of comfort and stability to the market. But we'll just have to wait and watch. But my feeling is that, unlike in the past, where retail investors would treat market volatility with some amount of fear, the thought that equity markets will see volatilities in pockets, that investor education and training has possibly helped in a great way.
Shibani, great conversation. Thank you for joining in. And in case we don't speak before Diwali, here's wishing you, your family, and the entire team a very happy Diwali. Thank you for joining in. Enjoy your weekend. Let's get to our segment D Street Chatter now. Nimesh is joining in for a complete insight into dealing room chatter and what they're doing on what's turning out to be a fairly brutal day. Nimesh?
Absolutely, a brutal day, a brutal week, and maybe a brutal month as well. So a big correction just before the Diwali. Actually, to some extent, I guess it spoiled the Diwali as well for a lot of traders and a lot of momentum investors, frankly, Rima. Again, what we are seeing is a clear signs of capitulation now, especially in the broader markets. The Nifty is down almost, the mid-cap index is down to almost 2.5%. The broader markets are down. The stocks are individually down 8, 10, 15% and all. And clearly now, after the 10% fall in the mid-cap index, looks like it's in a correction mode. So that's clearly been visible. Having said that, I've been saying for the last many days now that there has been aggressive FII selling, and within that, it's the long-only funds who have been aggressive sellers. But for today, the buy-sell ratio is close to 1:1. So it's even Stevens. So again, the feedback seems to be that today's fall is not led by very large FII selling. Yes, the FII selling continues, but it's matched by DI buying, and also the intensity seems to be quite low. That explains that there is a lot of capitulation, a lot of selling or lack of buying interest from larger HNIs and retail investors, which have been supporting the broader markets in the last many weeks and months. So that clearly seems to be the pain point now as far as the markets are concerned. Technically, we've broken the very crucial support of 2200 on the downside. So that was one level which a lot of bulls expected that will be protected. That's not been the case. So again, from a technical point of view, you heard Lawrence Blanco as well. There is a further gap for the markets to fill and to fall further. So the momentum is clearly on the downside now. And again, the other feedback is, Rima, clearly now the money is chasing quality over momentum and value. So that space will be further under pressure, at least in the time being, and the quarterly earnings are just not supportive. So all put together, the broader market pain could continue, but from a flow perspective, the intensity seems to be quite lower in today's market from FIs.
What about stocks, Nimesh?
So in terms of individual names, the first stock is Indian Hotels. In a weak market, that stock is relatively outperforming, up to 2%. Volumes are on the higher side. I believe there is interest back in that particular name, so there is delivery-based buying happening from larger FIs. And additionally, there was a Morgan Stanley note in the morning today. They've raised the target price and they've added the stock in terms of the technical buy as well. So that explains that in a weak market, Indian Hotels is doing good today. The second name is SAIL. The metal names are under pressure, but SAIL stands out on back of aggressive selling pressure from larger FIs. So it looks like there is a bit of profit booking now from domestic funds in SAIL. And the last is Mahindra & Mahindra. For the last 3 days, that stock is under tremendous pressure. Volumes on the higher side. I understand some long-only funds are active, very active, aggressive sellers. But at the same time, there is a bit of buying happening from domestic mutual funds as well. And for a while, as far as M&M is concerned, there has been an indication or a buzz of some corporate development as well. So yes, there is selling in M&M, but equally there is a bit of buying at lower levels from domestic funds.
Okay, thank you very much for that. Let's get to Abhishek now. He's going to give us a complete recap of the private sector banks that have reported their Q2 numbers and what the report card looks like. Abhishek?
Well, to begin with, let's start with the stock price movement. Nifty has actually declined by 4.5% in this month so far. If you take a look at the comparison of some of the banks' price, the top loser include IndusInd Bank, which has declined almost 28% in this month, including today's loss. Bank of Maharashtra, AU Small Finance Bank and Canara Bank, all above 15% losses they have given to investors. Now, on the secured lender side, they have outperformed Nifty. So, SDFC Bank has gained by 0.4%. SBI, ICICI Bank and Bank of Baroda have fallen below Bank Nifty's losses that you can see on your screen. So reason for massive decline in stock prices of unsecured lenders has been weakness in their operating profits, elevated slippages and the return ratios which has weakened for the likes of IndusInd Bank, RBL, etc. So to begin with, now NII growth has been very healthy for City Union Bank, Kotak Bank as well as SDFC Bank, while it has been weak for the likes of IndusInd Bank and RBL Bank as well. Operating profits have declined for IndusInd Bank and Kotak Bank on a sequential basis, while operating profit growth was good for City Union Bank, Axis Bank as well as SDFC Bank, which you can see on your screen for reference. Slippages were the key highlights of the banking results this time around. Slippage ratio improved for SDFC Bank, City Union Bank and Axis Bank, while slippage ratio deteriorated for the likes of IndusInd Bank, Kotak Bank as well as RBL Bank. So return on asset, one of the key metrics to watch out with respect to why the valuations of banking stocks do come up. Return on assets improve for the likes of Axis Bank, SDFC Bank and City Union Bank, while return on asset deteriorated for the likes of IndusInd Bank, Kotak Bank and RBL Bank as well. Just to give our viewers a key headline, Q1 FY25 4% ROA of Kotak Mahindra Bank that you see on your screen does include a one-off of about 3,500 crores that they have reported. And if you take a look on a one-year forward basis, price to book value, City Union Bank is now trading at 1.2 times versus IndusInd Bank, which is trading at 1 time. I don't know when was the last time that City Union Bank valuation on a one-year forward was higher than that of IndusInd Bank. Back to you.
Okay, well, that's very, very informative. Abhishek, thank you very much for that. So that's a comprehensive look at financials and where we stand now. We'll take a quick commercial break here. Another one, we're back. There's 14 minutes to go for market close. Stay with us.
Welcome back. Now, ICICI Bank will be reporting numbers tomorrow. Abhishek joins in with the key expectations. Abhishek, it's the last of the private sector banks. What are we expecting?
Well, it's the last of the large private sector banks, Rima. So weak earnings momentum expected as per the poll that we have from the brokerages who have given out the numbers. So with respect to business momentum, it is expected to remain strong. Deposit growth of 14.6% YOY and about 4.5% of 4% sequentially. Loan growth also expected to remain in the same range, 14.5% YOY and about 4% sequentially as per Motilal Oswal. Now, net interest margin can decline YOY and quarter-on-quarter cost of funds have been rising for the banking sector as a whole. Morgan Stanley estimates a 22 basis point decline YOY and about 5 basis point decline sequentially on the net interest margin. Provisions could rise on a sequential basis. We are seeing provision being elevated, especially on the defaults on the unsecured portfolio. So Morgan Stanley estimates a credit cost of 52 basis point in this quarter, which is up 7 basis point on a sequential basis. Asset quality can see some seasonal impact. Gross NPA ratio as per Motilal Oswal is expected to be at 2.3% versus 2.2% in the previous quarter. Management commentary with respect to business momentum ahead and the quality of book that will be sustained going ahead will be important. Our poll suggests NII growth of 9.2% YOY and about 2.3% sequentially. We are working with a profit growth of 7.5% YOY and a decline of 0.3% on a sequential basis. Back to you.
Okay, all right. Abhishek, thanks very much. Hopefully, ICICI Bank will sort of not disappoint like some of the other banking names have done this quarter. Stock right now is managing to bounce back in positive territory. Let's take a break on that note. Back with the markets in just a bit. Welcome back. Well, let's get you some key snippets and some interesting perspective that we got from our market veterans show yesterday, the market movers show that we had, the Diwali special. Now, a lot of them are actually not too worried about the slump that's ongoing right now in the Indian equity market. And many, like Ramdev Agarwal, call it a much needed healthy correction. Take a look.
It is the healthiest possible correction and overdue correction, I would say. And even if a bit more, in fact, it'll be deeper the correction, better it is for the people, because the expectations were going wild. Some people are saying that I want only 2-3% monthly return, month on month, that too compounded. So, that expectation was running wild, and once the expectations are way beyond, see, ultimately, even last 5-year return is just about 16% of the Nifty. The pace of decline in the earnings is quite alarming, and their estimate this for this quarter is just about 6-7%. Even if you see the business standard aggregates, it's just about 6-7%. And so we are not seeing too many bright spots in the earnings side, and markets are at all-time high. So these are two. See, market is also dull, dead, 12, 13, 14, 15p. That matches, But right now, market expectations are running at more like 15 to 20% kind of earnings growth. And here is a market which is kind of, and supply is building up.
Next 25 years look even better. Notwithstanding this correction, and we can discuss more about it, I don't think that the last few days give you any reason to worry about the next 25 years. This was expected. This is a healthy correction. There's the pace at which the money is coming. And the best part is a large part of that money is coming in the form of SIPs. And the 24,500 crores is, ticket size is 23 or 400 rupees per month per ticket. And that makes us very positive about the structural aspect of financialization of savings in India.
And you can utilize the weekend and catch a lot of those conversations that we brought to you. And of course, you'll find them on television and on our YouTube page as well. Back to Prakash for some final ideas and thoughts. Prakash, as we're speaking, the numbers from BPCL are flashing on the screen, and it's joining its cousin HPCL. Really disappointing from the oil marketing companies, right? What do you think is happening here, and what's the advice? You're on mute, Prakash. Yeah. Yeah, I think now we can hear you.
Yeah. No, I'm saying primarily it's a setup which is fairly negative for them. It's turned negative very suddenly, that too. Crude prices globally, the way they've been behaving, and of course, the lack of the ability to pass on any higher cost to consumers. That as a combination has worked against them. But let me tell you, that's very temporary. In fact, this is a very good opportunity for long-term investors to buy into an IOCL or maybe BPCL. In fact, BPCL would probably make itself the lowest price P multiple wise stock in the Nifty. So you're not overpaying for it in any case. This performance is probably a bad quarter, but that doesn't mean that you take away the replacement cost thesis here. IOC, BPCL, they are businesses that will take lakhs of crores of market cap to rebuild, and they're actually available at multiples which are fairly attractive. So I would believe from that 170, 180 IOC moving to 150, sub 150 is a very healthy correction in that sense for people to buy into it. So like anything else, you will always have a debate around whether this is the time to buy or whether you would wait for a further fall. But I think within PSUs, OMCs probably make one of the best buys at this level. I wouldn't recommend the same thing for defense and for railways and all, but for oil marketing companies, yes, it's a good opportunity to buy in.
Okay, that's as far as HPCL is concerned. Finally, as we're getting ready to wind down, the Nifty's managed to pull back a little bit. Let's get the intraday going. We'll take final thoughts with Prakash then. The bulls will have to sort of be content with the fact that at least the decline did not get even broader. There's been some semblance of a hold. That's what I'm talking about. So basically around 245 onwards, there's been some semblance at a recovery, and that's not been sold into. So that's sort of a bit of a ray of hope in an otherwise very, very bleak trading session, 24,200. Prakash, what's the advice? Would you be willing to deploy in now, buy in fresh at this juncture, or would you still be on the sidelines?
So, Prashant said when I was earlier talking to you that we'll get you back when things stabilize, and things seem to have stabilized pretty
Exactly. So I think you're a good luck charm.
No, so I think it is Prashant's wishful thinking. But more importantly, I think if you were to buy anything, it would be very stock specific. I wouldn't really look at the Nifty or the mid cap levels and the index levels and take a decision. But I'm saying some of the pharma names which we discussed earlier, some of the financials, though financials have been beaten black and blue, but I would believe after ICICI Bank numbers are out, you'll start finding some sort of a semblance of value in HDFC or probably ICICI itself. So I believe let the result season get exhausted. You probably have the picture very clear, and some of the consumption names also will start appearing in the buying list. But I would keep it very stock specific, Surabhi. And probably next week is going to be a very good opportunity once the numbers are through and behind us. So we'll wait for that, but definitely would start looking at nibbling into some of these names.
Okay, all right, Prakash, thanks very much. You have a good festive weekend, and we'll connect on the markets again. The bell has gone. The day is ending with a cut of about 180 points on the Nifty. So we're off the lowest level, and the bulls will take that with both hands. For the week, the index has lost about 2.5%. Let's talk about today's major movers. The biggest casualty of this result season, 19% gone from IndusInd Bank. That's the one that's really catching the headlines. The oil refining companies, refining and marketing companies, they've not had a good quarter. BPCL, after the numbers, is down about 5%. HPCL has lost about 6-7% as well. If you talk about more weak hands, Adani Enterprises, 5% lower. Shriram Finance is about 4% down. A lot of the auto stocks like M&M, Hero, Maruti, Bajaj, Tata Motors, I mean, most of them have seen fresh selling today. So weak trends there continuing as well. On the flip side, today actually it was FMCG to the rescue to some extent. You got ITC, Britannia, Lever. These are the names. Even Nestle, a little bit of green over there as well on the upside. And ICICI Bank is giving the hope to the bank bulls out there as it gets into its earnings over the weekend, 0.5% higher. And Axis Bank with Mr. Amitabh Chaudhary getting that extension. Good moves in that stock, about 2% up. But the real story of the day and the week has been the absolute carnage in the mid-cap and small-cap space. For the week, the mid-cap index is down almost 6%. The small-cap index is down 6.5%. And even today, there have been sort of major laggards and losers. Look at Dixon, 7.5% on the lower side. Patanjali Foods, after its numbers, 8% on the lower side. We were discussing BPCL and HPCL. Throw in an MRPL there as well on the oil and gas side. 7% gone from that stock as well. Poonawalla Finance, 16% down, by the way, on Poonawalla Finance. So some of these BFSI names have been really damaged in the correction that's been ongoing. 16% down there is what we are looking at. RR Cable, you heard the management here on the channel, 5.5% lower. Not a great quarter for the company. And you've got names like Petronet LNG, which have been on the lower side as well. Radico Khaitan, interestingly, good numbers. The stock was doing well in the first half of the day, but the ending is on the lower side. Just very quickly to sort of wind down on the volume charts. Bandhan Bank, Vodafone Idea, names like SAIL, RVNL, NBCC, a lot of these PSU stocks have had to deal with a lot of selling today. They're all down about 5% a piece. So tough day and tough week for the bulls. The question is, will the market find some at least near-term support? Whether the correction is over or not, the debate continues, but can we at least next week expect a near-term rebound? Well, on that note, we'll take your leave on this edition of Closing Bell. Many thanks for joining in, but the market action will continue. Editors Roundtable is coming up next.